Jeff Brown with Brown Wealth Management. Today we posted a new article on our site, which covers a wide variety of things, including the results of the election and a rotation that's been occurring. You see, since COVID started, we had identified what we had called COVID winners in the marketplace and COVID losers. COVID winners being stocks that would benefit from the stay-at-home orders across the world. And those stocks are well known: Amazon, Netflix, etc. And what we saw is the chart on our website will show is that as cases increased initially in the first and second waves, you also had the performance of the COVID winners do much better than the COVID losers. However, since the election, that has begun to change. We've had a rapid increase in the United States in COVID outbreak. However, we have seen a rotation occur to the COVID losers. And we think that that is because of the vaccines that have been announced, which have exceeded expectations across the board. In addition to that, something we've written about in the past is a high degree of concentration in the S&P 500 in the top 5 to 10 names. It's really gotten to a level that top 5 names have exceeded the dot-com bubble of 2000. And you have to go all the way back to the 1970s to have such a high ratio of equities in those top 5 names. So we think it's important to consider something different, to take a look at the S&P 500. And instead of ranking the S&P and weighting it according to market capitalization, perhaps weight it equally, where each stock gets their own weighting. What this does is it dramatically reduces the concentration in those COVID winners and those big cap technology stocks that are great companies but are very expensive today, and begins to reposition that into some of the areas that haven't performed as well. And we have a chart in on our website that shows the long-term performance of these two types of strategies to combine. So just food for thought of something to think about as the world begins to look forward to a reopening.